the first one we're looking at this evening. MRK, if you like Mark. Now, if you don't know, my name is James. Like I said, I created this trading strategy for my 9-year-old daughter back in 2008. Okay, one day she just came to me and said, Daddy, what are you doing? Can you teach me? So a 9-year-old is asking, can you teach me to invest in stocks and in the stock market? Well, most adults don't get it and don't understand it. So how am I supposed to teach a 9-year-old how to do this? All right. That being said, let's get rolling. Number one, it had to be simple, safe, predictable, consistent, and no way for her to lose. Now, that was for my 9-year-old daughter. Now, I had 5 rules that went along with it. Rule number 1, never buy something that's not on your list. Now, what do I mean by not on your list? Well, we check every single week. This week, there's 10,470 different companies to choose from. That's a lot. So the only companies that I like are companies that have been in business and consistently profitable for at least 2 decades. That's 20 years. Now, you might want to cut it back to 10, 15 years, whatever you're comfortable with. But it's a comfort level that you have to be okay with. See, now I'm okay with 20 years because it takes a long time for a company to get from, 1 or 2 years up to 10 years and then up to 20 years. Then after I'd say about 10 or 15, you should be pretty much profitable and consistently profitable. But at 20 years, you should really, have your shit together, so to speak, and be profitable. Joey Kent. Joey, do me a favor. Is there volume there? Because a couple of seconds ago, someone said there was no volume on YouTube. Can you hear the words? Can you remember Chris Tucker? Can you understand the words coming out of my mouth? Sounds great. Joey Kent said sounds great. All righty, that works for me. All righty. Now, anytime, wait a second, I was going over the rules, wasn't I? Rule number 1, never buy something that's not on the list. Now, when I say list, you have to choose what companies you like. Now, when you're looking through those 10,470 different companies, decide which ones you like and which ones you don't like. You can break them down by volume, how many shares they have traded on a regular basis. The more, the better. Okay, so think of it this way. If you pick a stock, Vivi Plays, I subbed, hope you're having a wonderful day. Yes, I am. Thank you very much. Think of it this way. If you're buying and selling stocks, you want to have what is called liquidity to get in, to get out, because you want to have a good fill price, you want to have a good sale price. Well, you can only do that with companies that have a lot of volume. Okay, take a look at, this is Merck. 33 million shares traded today. Well, that's a good number to trade. Okay. Now they have companies that have, just a few thousand shares trading a day. Well, that's like being the only person on the dance floor. Not a whole heck of a lot of fun. Issa Beast. Hello, how are you? Good stream so far. I just got here, man. Or you just got here. Find good stocks. Now, you can break it down by price, because I'm not sure about you, but I can't do stocks that are over $1,000 a share. There are a few of them. I like to stay under 300 and above 5. So $5 to 300 is my range for me. And then for shares traded on a daily basis, well, I like to look at 300,000 or more. Okay? Then you can look at, well, do they have options? Are they profitable? What's the book value? What are their earnings? Are they consistently increasing their earnings? A lot of interesting things go by. So 1, pick a good set of stocks. So for me, it's Dividend Kings. Those are companies that are consistently profitable for at least 5 decades. That's 50 years of consistently increasing their profits year after year after year. Well, that just makes sense to me. It's like, okay. Rule 2, never sell at a loss. Wait a second, hold on. Oh, that was Dividend Kings. Let's go back to the list. Dividend Kings, Dividend Aristocrats, 25 years of increased profits. Dividend Champions, 25 years of increased profits, but the rules are a little different than the Aristocrats. So the Aristocrats and the Champions both have 25 years of profits, but the rules are different. List number 4, Dividend Contenders. These are companies that have been profitable for 10 years to 24 years. Didn't quite make that 25-year mark, but still 10 to 24 years. Great. Pick a company that you like. And lastly, list number 5, we're going to look at Warren Buffett's list. Okay, I don't know about you, but if it's good enough for Warren Buffett, it's good enough for me. Fine. Dan, it is your 5 list. That's about 300 different companies. So, number 1, never buy anything that's not on your list. If you don't like it, don't even bother looking at it. It's just no reason. Why would you look at something that you're not going to buy? It just makes no sense. All right. Rule number 2, never sell at a loss. Sprout, thank you for that. Mango, hey, been a minute since I seen you here. Did you get in on the gold mining stocks? Absolutely no. Okay, gold mining stocks, unless it has 20 years, 2 decades of consistent profitability, I have no desire to look at them. Sorry. Rule 2, never sell at a loss, defeats the purpose. I mean, we're here to make money. Why am I going to buy something for $100, 6 months later sell it for 80 or 70, 50? I have no desire to sell for less than I paid for it. So when I buy something, I go with the intention of holding it, even if it goes down, but holding it until it hits my target. So look at Merck right here. Merck's at $90. If I buy it tomorrow morning at $90, it can drop down to 10, 15, 30, 50, 60. It can drop down to whatever. But if I buy something, I'm going to stick to rule 1 and rule 2. Never buy something I don't want to hold on to long term. Because if they have a dividend and it increases every single year, well, odds and probabilities are that the stock is going to come back up to where it should be because the company is consistently profitable. I mean, that just makes sense to me. Rule number 3, make sure the company's consistently profitable. We just talked about that. Rule 4, weekly options only. Okay? Rick wants to take a look at UPS. Hold tight, Mr. Rick. All right. Mr. Rick wants to take a look at UPS. Rick, we'll look at that in a second. Rule 4, weekly options only. I want to get weekly cash flow. That's it. Okay, I don't want to do monthlies because I can only do that once a month. Okay, if it doesn't have a dividend, that means I have to go in and read all those damn quarterly reports and annual reports. And then I have to study the charts year after year after year to find out when does it move predictably on a consistent basis. Because dividend stocks, let me pull this up for you. Because what I tell people, what I do, is one thing. What you do, that's something totally different. Rule 1, pick out a good set of stocks. Okay, so let's take a look at some stocks that are consistently profitable for at least 25 consecutive years. Right there. Here we go. See, all these companies have been consistently profitable for 25 years. And they have a dividend in the month of October. Okay, today's the 1st. So APD, CAH, FRT, and O all had their dividends today, or the EX dividend today. So if you wanted to collect the dividend for this, you have to buy it before today, which was yesterday, the day before, last week, week before, whatever, to collect the dividend. Now, I don't want to collect the dividend because these little green dots is the EX date. That's the last day the stock trades before the dividend is paid. After the dividend is paid, the stock goes down. Before the dividend is paid, the stock goes up. So the stock goes up coming into this date, and then after this date, the stock goes down. So I want to jump in before the dividend is paid. And then jump out before the dividend is paid. Either way, I'm still looking for that 1% every week. All right, give me a second. Ooh, that's much better. All right, let's get back to where we were. All right, so we're looking at Merck. When I look at a chart, I'm looking for 5 things and only 5 things. And it takes me 3 to 4 seconds to find all. It's kind of like finding, where's Waldo? Where's Waldo? Or where in the world is Carmen Sandiego? Remember that? Where in the world is Carmen Sandiego? Oh, where's Waldo? Same thing. 5 things, ready? Number 1, the high of the year. Number 2, the low of the year. Those are pretty self-evident. I mean, you can take one look at it and say, oh, there's the high, there's the low. And then the other ones, you ready? Where was it a year ago? Well, that's pretty easy. Where is it right now, today, or right here? And what is the movement since the beginning of a year ago to today? So we just take our pen. Down, up, down, up. It's that easy. And it should take you 3 to 4 seconds to see that. Let's try something for a second. There it is, right there. Oh, I have an idea. An idea. Watch this. You're gonna like this. You're gonna like this. All right. We're gonna pick right there, Leggett and Platt. All right. Now, one thing before I go on any further, just in case you didn't know, this screen behind me is live on YouTube. So you can go over to YouTube on my YouTube channel, which is The 10-Minute Trader. Remember all the videos you've seen me? Hey, this is James from Dividend Stock Talk, brought to you by The 10-Minute Trader. So two channels here. One is Dividend Stock Talk, which a lot of you are on Dividend Stock Talk, and the other one is The 10-Minute Trader. Okay, the 10-Minute Trader was here first, about 20 years ago. Now Dividend Stock Talk. Okay, so what am I doing here? This here is Think or Swim. Okay? Now, Think or Swim is the trading platform that I like. Now, I've been using it for over 20 years, and that's awesome because they haven't changed it. I'm one of those creatures of habit. You know, I like things to be the same. I turn my computer on, and I want everything to be where I left it. I hate it. Hate it. When I open up my computer and the very first thing it says, congratulations, you have been updated to the new trading platform. It's like, no, I didn't want it. If I had my way, I'd still be using Windows 95. I liked Windows 95. It was seamless. Everything worked fine. And no, all this new crap I do not use. I still use the same crap I used back in 1995. Anyway, don't get me started. All right, so what we're looking at is a list of stocks, the chart, and the numbers. Okay? This is one of the reasons why I like this. Now, I can take just one little finger and hit the up button or the down button on the on the keyboard. And it's going to go one stock at a time. And as it goes down one stock at a time, it's going to bring it into the chart, which I'll be able to see the high, the low, where is it? This thing, look at this. This is going up right here, okay? Well, that looks great. But what doesn't look great, this right here. These are months. That shouldn't even be on my list. That's Leggett and Platt. That's a Dividend King. All right, so I'm going to hit the back button, boom, and that's gone. Simple. That was easy. Okay, so Flick. Flick has no options. Let's get rid of that. Walgreens. Nice. All right, we're going to do this right here. All right. Walgreens. Right there. High, low. Where was it? Where is it? Look at this. Up, down, up. Whoa. What's going on here? All right. That looks interesting. $12. $12, no options. What the hell? Well, why is it saying that? Huh. All right, well, that's working. All right, so back over here. MDU, that shouldn't be there. Then that shouldn't be there. That shouldn't be. What the hell list am I even on? Let's find a different list. Oh, that's just quotes. I don't want that one. I want this one right there. There we go. Huh, why isn't that working? There it is right there. All right, K-View. All right, interesting. All right, let's do it this way. All right, these are all the companies that are at least 25 years of profits. Is that right there? And as I go down one at a time, guys, just hit the down arrow. Next, there it is right there. The high, the low, where was it? Where is it? No, it's going down. Next. Okay, high, low, was, is. And now it's going up right here. 2480, 2450, 0. Oh, what the hell is this? Hormel, the 25 is going from 20. No, the numbers just don't look good. Next. Interesting again. And it's a monthly. No, Brown and Foreman. Why is that even on here? All right. Fast Terminal. All right, here we go. What is this one? ADM. Okay. It's going down. It's the high right there. Now she's going down. 59. No, thank you. Next. Oh, this one's going up. Nice. It's a monthly. No, thank you. I should use my own Coca-Cola. Look at that one. High, low. Where was it? Where is it? Down, up, sideways, down. Now she's going up. 67. 67 is going for 61. Not quite 1%. No. It's actually that simple. That's one of the reasons why I like Think or Swim. Because I can just go down one at a time and find out who is looking like this. That right there looks pretty damn good. Okay, you got your 30-day high here, your 30-day bottom here, 3 days to the upside. Well, you can't get any lower than the low of the year, and that was Monday. Tuesday was higher, Wednesday was higher. That's 3 days to the upside if you like Coca-Cola. Well, that's pretty simple. We all like Coca-Cola. Well, I think we all do. What do you have over here? La 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 la. Questions. What do we have? What do you think AT&T as a potential candidate? Have you ever traded AT&T? Well, let's find out AT&T. AT&T, here we go. Not this week. The high of the year right there. Now she's pulling back. Well, it might be good in a couple of days. Even tomorrow. We can find the bottom tomorrow. Okay, 29.80. Now she's dropping. Where's it going to end? We don't know. It's got to end somewhere. Then it's going to bounce off that bottom and go back up again. Well, 27.55, the 27.50 is going for 33. That's more than 1% if I like AT&T. But as it's dropping, why would I jump into it until it finds the bottom, like right here? See, here's the bottom here. Okay, top, came down, stopped, went up. Okay, here it is. Now she's coming down. How far down? How low can you go? How low can you go? You know, that type of scenario. Oh, how low can it go? It's AT&T. They've been around for a very long time. What do we have over here? Rick wants to take a look at UPS. All right, what else do we have here? No, we don't. Ripping. MB. What is MB? What are you guys saying over here? Asteria Labs? Nope, 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 nope. All right, what are we looking at? I started paper trading, and my shares went worthless after my covered call. Could you show how to do a call when you own the stock? Absolutely, Joe. All right. Well, let's look at UPS for a second, and I'll get right back to that question. At the high of the year, 145. The bottom of the year, 83. Okay. Up, down. Now she's going back up again. Oh, that's UPS. Look at the last 30 days. Okay, last 30 days. Here's the high, here's the bottom, down, up, down. Now she's going back up again. She's at 84.38. The 84s are going for 162. That's over 2%. And the question you should be asking yourself is, do I like UPS? Do I want to hold on to it, and do I want to keep it? Well, let's do a covered call at 85, just for those that are new here, see how it works. And then I'm going to do Joey's request, show him how to sell a call option against the stock you already own. Well, that part's easy. All right, 85 is what we're looking at. 85 is right there. One contract, right there. Market order. And here we go. So this is what the order should sound like and should look like. This little green line here. That's what it looks like. That's what it sounds like. Just read it slowly to make sure you understand everything that's there. Buy one covered call UPS. Well, that tells your broker what you're doing. I'm buying a covered call on UPS. And the broker understands that you're buying the stock first and then you're selling the option after. 10 October 25. That is next Friday. Not this Friday. It's next Friday. The $85 call option, which means I'm selling it whatever the price is now, $84.38. I'm selling it at 85. This is what I'm collecting, $134, and it's costing me $8,300. Well, whenever you make an investment, well, that's what we're doing. We're making investments. It's going to require some type of capital. Well, for 100 shares of UPS, that's $8,300. Now, I'm kind of hoping, okay? I'm kind of hoping when you get in your 60s and 70s and you're ready to retire, well, you should have at least 6 digits, 100,000. You should, after working 40, 50 years. If you think about it, 40 years, $100,000, that's not even $8,000 a year. Not even. Anyway, besides the point. So once you get however much money you have, this order right here, to buy 100 shares of UPS, sell one covered call. So I'm buying it at $84.38. I'm selling it at 85, and I'm collecting this right away. Right away. I don't have to wait for the stock to move. Most people buy the stock and have to wait for it to go up. Now, I could, if I wanted to, buy it here at 84.38 and sell the 84s. Well, it's a safer trade. So let's do it both ways, the 84s and the 85s, and see which one is more profitable. So the 85... let's do that one right now. Need the calculator for this one. I'm good, but I'm not that good. All right, so the profit, 134.50. And then we take the profit and we divide it by the investment. The profit Max profit, 134. Do you remember the part where I said I want it simple, safe, predictable? When I say predictable, I want to know how much money I'm making before I even make the trade. Because most people buy a stock. Well, if you buy a stock, you now have to wait for it to go up in order to make a profit. Well, the covered call, the stock doesn't have to move at all. So if I buy it there, sell this, I'm getting this the very same day. That's my profit. And then if it hits this right here, 85, then I'm jumping out. Now we're going to do the 84 and then we're going to do the 85 and see which one is a better trade. Okay, so me personally, I do the 84s because I want safety. Now some of you might be younger, are going to want more profit. Well, it's okay because you're younger. It is what it is, which means if you look at it this way, you have the opportunity, more so than I do, to fix any mistakes you make. So if I make a mistake and lose a lot of money, well, I'm retired. It means I have to go back to work to replace that money. You being at work, punching that time clock, punch, punching that time clock every day. If you make a mistake and you lose some money, well, guess what? You just added to it from your salary or from your paycheck. Well, it's a hell of a lot easier than going out and getting a job, especially when you're over 60. Because I go to get a job and I'm over 60, they're going to look at me differently than if I was in my 20s or 30s. Not to say that I can't keep up with them. It's just, it is what it is. I'm 61, going to be 62. Things just don't work like they used to. And that pisses me off like you wouldn't believe. I mean, it's a horrible sensation. You wake up in the morning and you say, wait a second, that thing was working yesterday. Why isn't it working today? It's going to happen. I know some of you are laughing right now, but guess what? When it happens to you, just think I'll be laughing. Anyway, so you take the profit, 131.50. Ooh, why did I write 134? Okay, Claire. 131.50 divided by the investment 83.69. That comes to 1.57. Okay, 1.57 if you like UPS. Also, don't forget, if you buy it at 84.38 and you sell it at 85, you also get the difference between the purchase price, 84.38, and 85, which is an additional 62 cents per share. And it's always per share. I mean, that adds up pretty damn quick. Okay, but the stock has to go up in order for that to fulfill. So let's take a look. If we do the 84s, all I have to do is just change this right here from 85 to 84. It's pretty easy. So I change it to 84. Now, the numbers are going to be different. Okay? Now I'm making $87 per share, and it's costing me $8,300. Well, that's not as good, but it's a safer trade. You always got to keep that in mind. Safety over profitability. All right, so I got noise coming over here. I have no idea who that is. It wasn't that difficult finding that one. All right. We're going to look at the gap in a little bit, all right? Fab, I'm going to look at yours in a second. Sit tight. So this one, at 85, it's 1.5. All right, well, let's do the 84. The 84 is $87, and it's 83.13. That's 1%. All right, so 1%, it's safer. So if I do it and buy it at 84.38 and I sell it at 84, I'm making 1%. Fine. If I do it at 84.38 and sell the 85s, I'm making 1.5%. But the stock has to go up in order to get all my money back. But you got to keep in mind, am I okay owning UPS for the long haul? That's just the question. Do I like it enough to buy it, hold on to it for long term? Now, who was it over here? Joey. Joey wanted to know, how do you sell a covered call on a stock that you already own? Well, you already own it, so you don't have to buy the stock, sell the option. You already own the stock. So now all you have to do is sell the option. And that is single, because you're just selling one option. You're not doing a multiple trade, not buying a stock, selling the option. Because once you click onto here, these are all the different trading strategies. Single, vertical, back ratio, calendar, diagonal, straddle, strangle, covered, synthetic, blah, 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 blah. All those. So if you already own the stock and you just want to sell an option against it, it's single. Okay, you want to do a covered call, buy the stock, sell the option. That's 2 trades in one. That is the covered call. Okay? And when you get down to here, some of these, they get really complicated. We're not going to go over those, but just to let you know, they're there. All right, what do we have? What do we have next? All right. Let's say, okay, we did that question already. What do we have next? AT&T, we did that one already. I saw one of your videos. For example, the stock is $10. You placed a call $9.90 with the premium, but you misused used the 10 from the strike. Oh, you minus the 10 from the strike price of that premium. I was sort of confused, and it was hard to explain. Hopefully you understand what you, okay, perfect. Okay, Fab, you ready? Perfect example right here. All right, Fab, you ready for this? If I'm buying a stock, UPS, the current price is $84.38. Now, if I decide to buy it at $84.38, sell the 84s, which we were just talking about 2 seconds ago, the 84 is going for $1.62. However, if I buy it $84.38 and I sell it $84, I'm losing 38 cents per share. That 38 cents per share has got to come from somewhere. So if I subtract the 38 cents per share from the premium I collect, 162, what am I walking away with? I'm walking away with $1.24, right? $1.20. So you take 38 cents, you subtract it from 162, it should be $1.34, I think, or $1.24. $1.24. But $1.24 is still more than 1% of 84. It's percentages. So it's a safer trade, 84.38, selling the 84s, then you're still getting 1%. The stock doesn't have to move at all. If it goes up, great. If it stays exactly where it is, great. It can even come down, and I'm still great. Stocks only go 3 different ways. They go up, they go down, or they just stay flat or go sideways. So if I do this trade, buy at 84.38, sell the 84s, if the stock goes up, great, I make a profit. If the stock stays the exact same, I still make a profit. If the stock even comes down, as long as it stays above 84 by Friday, I'll have all my money back on the following Monday, and I walk away with that 1%. That's ideal for me. That's what I'm looking for. Rotate, a revolving, think of a revolving door. You go in, drop off your money, and you come back out again. Anyway, next question. Fab, I hope that answered that question. Hey, James, can we look at the gap? Lisa G, of course we can look at the gap. Fall into the gap. I remember that commercial from the 80s. The gap. Where everybody gets their cool clothes. That's where we see, when I grew up in the 70s and 80s, okay, we lived in rural America. Rural, okay, you understand that? What rural means? That means it was 3 miles to the corner store. Hubbard's Cupboard. That's what it was, Hubbard's Cupboard, a little tiny store. And it's still available today. Because I remember Jay Hubbard was in school with me on the soccer team, and his family owned Hubbard's Cupboard. Because it was a small town. Okay, anyway. So it's a 3-mile ride from home to the corner store. And then it was a 15-mile ride to the closest mall, and that was the Hanover Mall. And that was a day's event, especially with 6 kids. Because you throw 6 kids into the car and drive on over to the mall, and it was a once-a-month treat. And we would go once a year, because this is what poor people did. We go shopping for our school clothes once a year, a week or two before school started. And we always wanted to go to the Gap. Well, that was the store back in the 70s and 80s. Let's go to the Gap. They have the cool clothes. I remember Levi's corduroys. Those were the big thing back in those days. Anyway, I'm getting sidetracked. Sorry about that. Squirrel! Yes, I do. I have ADD. I have no problem admitting it. I have trouble concentrating single-mindedly. Amazing how I got this far in life. I can't concentrate on anything for a long period of time. Anyway, so that's the Gap. Here's the high. The low, where was it? Where is it? Up, down, up, down, up, down. What's going on here is turning around. Look, here's the top. Here's the bottom. Now she's turning around, going back up again. Well, great. Do you like the Gap? That's an honest question. Do you like it? Is it consistently profitable? Do you want it in your roster, on your list? Is this a stock you want on your list? It's either yes or no. The price is $21.65. I'm going to be looking at the 21.50s. And they're going for 60 cents. That's more than 2.5%. Well, the numbers look good. The chart looks okay. But you still didn't answer the question. Do I like this company? Do I want to own it, hold on to it, never sell it until it hits my target? What's my target? 21.50. What's it at right now? 21.65. It kind of makes it easier when your target is below your purchase price. Because it's not like I'm buying it at 21.65 and I want to sell it at 23. No. I want to sell it at 21.50. That's 15 cents below what I just paid for it. But if I'm collecting 60 cents per share, I take that 15 cents off of that 60, and I'm walking away with 45 cents per share. Well, that's still more than 2%. Okay, let's look at it. Let's look at the numbers, see what it looks like. A year ago, 21.47. Hold on a second. If it's a 21.47 a year ago, and now it's at 21.65, what the hell did we do for the whole year? It went up, it went down, it went up, it went down. Now we're back to where we started again. What's the point? Anyway, shoots up, pulls back. There's the bottom right there, second week of April, 16.88. Ooh, we topped out at 29.29 towards the end of May. And then we had a big gap down from 28 all the way to 22. 28 to 22. That's a $6 drop. A $6 drop on a $28 stock is what, 22%, something like that? That's a big drop. So what did it do? It dropped, went up, down, up again. Pretty simple looking at it that way. Well, I want just the last 30 days because the last 30 days gives me a good idea of where I think it might go next. Because stocks are repetitive. They do the same thing over and over again. They go up until they're done. They go down until they're done. And then they go back up again. And then it's going to go down. And then it's going to go up. And then it's going to go. It's boggling how it does three things. That's it. Up, down, that's it. So if this is the bottom yesterday, okay, today is the upside. That's 2 days to the upside, yesterday and today. So tomorrow or Friday might be a good indication to jump in to the gap. Well, especially if it's going to give me what it looks like. So let's do it at 21.50, see what that says. For those of you that like the gap at this current price, the 21.50 right there. Okay, just one contract because we don't want to buy too many. Get a good idea what one should look like. Okay, here it is. Buy one, covered call, gap, 100. That's the weeklies. 10 October, that's next Friday. That means this option is going to expire, win, lose, draw, whatever, next Friday. The 21.50, that's the price I'm selling it for. I'm buying it at 21.65 and I'm selling it at 21.50. I'm walking away with 48 bucks. Now you're probably thinking, 48 bucks, that's it? Hold on, don't be so quick to judge. Plug in the numbers, see what it says. Because $48 on a $2,000 investment, that's got to be over 2%. And if I can get 2% every single week, that's over 100% by the end of the year. It is. It's 2.28. Okay, 2.28%. It doesn't sound like a lot. $48 off of a $2,000 investment. Now think of it this way. Don't think of it as you're buying stock. Think of it as if you're buying a weekly cash producing asset. An asset that has the capability of giving you some money every single week. Now, there's no guarantee to what amount that's going to be because these numbers change all the time. Let's get rid of this. I'll show you which numbers I'm talking about. Here we go. These numbers, okay? The bid, the ask, the open, the high, the low, that's just the stock price. And then down here is all the call options, and these are the put options. Okay, here's your bid, here's your ask, here's the strike prices, and every 5 or 10 seconds they change. Change. Because people like you and me come in, we buy, we sell, and that creates turmoil in the market. The turmoil looks like this. Up, down, up, down, up, down, up. That's what the turmoil looks like. We buy, we sell, we buy, we sell. Okay? And as we're buying and selling, these numbers keep changing. But you know what doesn't change? Oh, I dropped my pen. You know what doesn't change? The math. The math doesn't change. What did I buy it for? What strike price am I selling? What am I collecting? And then you divide the profit by the investment, and that, depending on which one of these you do, 3 October is this Friday, 10 October is next Friday, 17 October, 2 Fridays away, 24 October, 3 Fridays away, 31 October, 4 Fridays, and then we get into November. Holy shit. November's next month. The year, oh, we're in Q4. Holy cow. Anyway, so the numbers may change every day, but the math problem doesn't change. What am I buying it for? What am I selling? What am I walking away with? What's my profit? Is that more or less than my goal? Now, my goal is 1% a week. That's my goal. Okay, you know what my goal is. You have to figure out what's okay for you. Now, think of it this way. If you're okay with it, 0.5%. 0.5% a week is still 26% per year. Well, that's not that bad. So if you like, let's look at Coca-Cola, because Coca-Cola never gives, well, I should say hardly ever gives 1%. See, look at Coca-Cola. Here's your high, drops. Here's the bottom. That's definitely the bottom. Now she's going up. It's Coca-Cola. It's been in business for over 140 years. There's a high probability that they're going to be making Coca-Cola long after you're gone and long after I'm gone. Okay? But what are they offering? 66.78. The closest strike price is going to be the 67. The 67 is going for 61 cents. Now, 61 cents on a $61 stock is probably around 8.5, maybe 9. Okay, not 1%, but 0.8. Let's find out. Okay, the 67 is going for 61. And we're going to divide that by 67.9. 0.91%. Well, that's not bad. Multiply that out by 52 because there's 52 weeks in the year. Multiply that out by 52 because there's 52 weeks in the year. That's still 47.3% for the year doing Coca-Cola. Coca-Cola's a dividend king. They have 5 decades of consistent profits. They're always making money. Coca-Cola is the #1 soft drink, not in the United States, in the world. The #1 soft drink in the world is Coca-Cola. They just sell so much of it. Anyway, that's if you're okay with it. You always have to think, this is my money. Is this okay for me? That's it. If you're okay with getting less than 1%, there's nothing wrong with that. You just have to be okay with whatever number that is. All right. All right, so we already did that one, Joe. Michael Anthony, AI markets are the new tech boom. This guy probably missed out. Google, glad I didn't take your advice on NVIDIA. Michael, I'm going to agree with you 100%. But Michael, you're looking at it from your point of view. And your point of view is great for you. Okay? NVIDIA and Google are not dividend stocks. They're not companies that you invest in to get cash flow from. Okay, I'm looking for cash flow. I honestly don't care about buying a stock and watching and waiting year after year after year for it to grow. Sorry, but my bills come due every single month, which means I need cash flow. I don't need a promise or a hypothetical, hey, if I buy it today, maybe in 10 years it will be worth a hell of a lot more. Sorry, I'm not in the same position that you're in. Okay, when you get retired and you're no longer bringing in a paycheck every single week, your money has to come from somewhere. All right, and if you want to do risky trades when you're retired, hey, more power to you, brother. I have no desire to be forced to go back to work if I'm wrong. Also, NVIDIA pays a 1 penny. It's like $180 per share, and it pays 1 penny dividend. Hell no, not for me. And Google, yeah, they may have been around for a while, but they only have 2 years of dividends. That's it. So, insult me all you want. You and I are on different paths, and there's nothing wrong with that. Okay, you're looking for a profit in what you're doing, a little bit more risky than me. I want safety over profitability, and that's where we differ. And there's nothing wrong with that, because there are literally hundreds of thousands of people just like me that want safety and predictability, just like there are thousands of people being in the exact same position you're in. They want excitement and high risk, high reward. Well, great. You can do that when you're younger, but as you get older, it's less appealing. I hope you understand that, Michael. Astera Labs, go look at it, not him. He will tell you no, up 200% this year. Well, Anthony, or Michael Anthony, it would be great if you told me what Astera Labs ticker symbol was. Okay, just because it's up 200%, I can point out dozens upon dozens upon dozens of stocks that are up 100, 200, 300, 400, 500%. There's over 10,000 different companies. How do you find those? You can't find a stock like that every single week. It just doesn't work that way. And people like you are always saying, hey, I bought this, it jumped up 200%. Yeah, but you're not showing me all the other trades that you may have done along the way where you didn't make money. Okay, the accounts that I share 3 accounts publicly. I show you the winners and the losers. It just so happens that 99% of my trades this year, or I should say 98% of my trades this year, are all winners. I only have like 4 losses this year. Well, that's pretty damn good. But then again, I'm looking for small profits, not big profits like you're looking for. Small profits are perfectly fine for me. And if this is not the place for you, well, it's not the place for you. Because I'm not looking for the same thing you're looking for. Okay? There are plenty other people showing you something that's more in your field, so to speak. She's it. Micron is the future. Micron's MU. Rick, we've already looked at UPS. Here's Micron. Who said Micron? Creed Stanchion. Okay, Creed Stanchion. Don't get me wrong. I mean, I have done Micron a few times, but not today. I don't ever buy anything at the high of the year, and that's exactly where Micron is today. So why are we looking at it? What's the play here? See, we're here looking for opportunities, and so you say, hey, look, this is at the high of the year. Okay, what do we do with that information? Is it going to go higher? If so, what is your reasoning for believing that? Just because you think it's going to go higher? See, 120 30 days ago, now it's at 180. Let's see if you can understand this. 120, 180. That's a $60 increase. $60 on a $120 stock is a 50% increase. So a stock jumps up 50%. I don't care who you are. I will take profits at 5%. I sure as shit going to take them at 50%. I'm not looking to buy something that already made a big move. Because eventually, this thing is going to come back down again. See, it was here. She jumped up and pulled back. Now it jumped up again. Well, guess what? It will pull back again eventually. Now, I'm not looking to put my money into the high of the year. Okay, I want predictability, consistency, safety, and profitability. That's what I want. I'm 61 years old. I don't have the luxury of being wrong like you do. You're still working 30, 40, 50s. I have no idea how old you are. But if you were retired, you'd have a total different look at where your money is and where you're putting your money. Okay, so people that are retired and rely on their income to live the lifestyle that they want to live, well, it's got to be safe. Okay, because it's got to last me the rest of my life. And I'm not going back to work, punching a time clock for 40 hours a week now. All right, where are we? Let's get some questions here. Dr. Dev's in the house. Serial killer. Neil Diamond Auto. Okay, Willie B. Mr. Adam Casey. What's going on? Shopchi. Akel Bori. Okay. Kid Shriver. Orion. Gabriel. Hello. Any free to use dividend calendars out there? Yeah, Gabriel, your best bet is to go and take a look at Google and go into EX dividend calendar on a Google search. Okay, I use the one on Thinkorswim because it's free and I like it, and I can insert my own stocks into it. Bum, 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 la, la, la. Diana, on my way. Oh, my goodness. Okay, wow, I'm missing all these questions. Uh-oh, I got to get comfortable now because these quite a bit of questions here. Diana mentioned something about my pants. Brian, thanks, man. Because of you, I want to sell some covered calls. What do I think of JEPI? Oh, my goodness. Brian, okay. Rocky, how you doing? Brian, you ready for this? Let's go take a look at JEPI, and I'll give you my opinion. Okay? JEPI. Now, Brian, I told many times, I like companies that are consistently profitable. That means year after year after year, higher and higher and higher profits. That's what I'm looking for. Okay? So let's take a look at JEPI. There it is right there. See? JP Morgan Equity Premium Income, JEPI. All right, it's at 56.85. Now, here's the issue I have with JEPI. It's only 5 years old. Okay, Brian, you see that? The very first dividend JEPI paid out was July 2020. July 2020 means it's only 5 years old. Now, I won't invest in a company that's 5 years old. I want a company that's at least 15, 20, 25 years old. because companies don't get their peak, their momentum until somewhere around 10 or 15 years. 5 years is, most companies don't make it to 3 to 5 years. All right, anyway, so here we go. 2020, the very first dividend was 49. So it goes from 49 to 29. Okay, that is a 20-cent drop. A 20-cent drop on a 50-cent piece would be 45% drop from here to here. So 49 to 29, that's backwards. 45, that's up. 43, that's backwards. 51, that's up. 50, that's backwards. 54, that's up. 26, that's backwards. 32. There's 32 right there. 32, 37, 31 backwards. 39, 25 backwards. 33, 34, 36, 38, 45, 38 backwards again. 46, 51, 62, 49 backwards again. 55, 48 backwards again. This thing went down almost the exact same amount of times as it went up. It's a 50-50 shot. Okay? From 38 to 45, that's going up. 45 to 38, that's going back down again. And then it goes to 46, that's up. 58, that's up. 46, that's down. It goes up, it goes down. It goes up, it goes down. See, I only like consistency of profitability. Consistently profitable. Every quarter, every year, every decade, over and over and over again. Higher and higher and higher profits. It should look something like this. Now this is Microsoft. Microsoft goes back all the way until 1989. Come on. Oh, sorry, 1986. I only want to go back to 2005 because that's 20 years. That's far enough. All right. Who said that one? JEPI? Okay, Brian, you ready? Watch. 8, 9, 10, 11, 13, 16, 20, 23, 28, 31, 36, 39, 42, 46, 51, 56, 62, 68, 75, 83. Did you see that, Brian? Every single year, higher and higher and higher and higher dividends. 25 years or more. That's Microsoft. More than 25 years, higher and higher and higher dividends. Now, I'm not telling you not to do JEPI. You asked my opinion. I don't like it because it's not 20 years old. It's only 5 years old, number one. And number two, it's not consistently profitable. The profit should be higher and higher and higher and higher year after year after year. JEPI is not, and that's why I don't like it. All right, anyway. Brian, thank you, Brian. Dr. Dev, go to Micro Center for the computer repair. Geek Squad doesn't know what they are doing. Micro Center. Is there a Micro Center in St. Pete? Hold on a second. Hold on. Don't go anywhere, guys.